Hello, good afternoon. I usually do these in the morning. It's a little bit later in the afternoon today. Um, I put this together yesterday, but I didn't get a chance to do it. So I'm going to do it today, even though the market's closed right now. I think it's a timely and valuable uh, topic. So anyway, Ken Krager from Black Swan Financial Advisors. With my Black Swan Breakthroughs podcast, financial strategies for thriving through life's unexpected turns. My website, again, it's under construction. It should be up and ready and running hopefully by the end of June 2023. By the end of June, I'm redoing the whole thing. There's my YouTube channel. Please subscribe. I hope you find my videos valuable, and here's my email address. So one of the things I wanted to talk about today, again, educational purposes only. These videos are for educational purposes only, and I found it interesting, some of the commentary the last few days and the banking crisis and everything. And I saw a chart that I'm going to show you in a minute about banks are tightening their lending practices. And that's, again, the Fed's trying to slow down the economy so they can slow down the rate of inflation. And it's quite interesting. I find that the Fed wants to lay people off, basically. They wanted the job market the unemployment to go up and people to lose their jobs. And but anyway, been kind of waiting for a credit collapse or a credit crisis for quite some time. Back in 2008, 2009, there should have been a correction. So before that, about every 10 years or so, there's usually a credit crisis and a collapse where there's a lot of bankruptcies, companies that have too much debt. You hear about zombie companies, which are companies that basically don't even make enough money to cover they don't make enough profits to cover their interest expenses, these zombie companies. And usually about every 10 years, the credit market will roll over. There'll be some bankruptcies, and the dead wood will get taken out, and it'll go up. But what happened in 2008, 2009, the government stepped in and called that rescue, and saved a lot of companies and banks and stuff, and short-circuited that cycle. So it wasn't as drastic and it wasn't as long, but you still had a lot of companies that probably should have gone bankrupt and gone out of business that still existed. And then again, in 2000, in the COVID thing, and in 2020, and then again last year, but finally, it'll be kind of interesting that what's happening is interest rates have gone up so much that the cost of refinancing these businesses, has gone up considerably. And so I'm waiting for this credit crisis to happen again. And it hasn't happened really badly yet, but kind of interesting that the banks, you can usually see these credit crises are usually led, or in the beginning you see banks start to tighten their lending practices, and it's harder to get a loan and they don't lend as much money. And it's been interesting because even before the bank collapses, Silicon Valley Bank and First Republic and some of the other ones, then there was already some bank tightening happening in the early part of the year that nobody talks about. Okay. And then right now, money market funds are booming, right? I mean, who wants to get 0.1% in your savings account at the bank when you can get 5% in a money market, right? Short-term treasuries are over 5. So what's happening though is that's sucking money out of the banks. And actually, the latest one, PacWest, I think, uh, in one day they lost $32 billion of deposits. I mean, it's just crazy. And then there's been some talk about the commercial real estate business, but commercial and industrial loans, which are done, actually a huge percentage of those small business and the commercial real estate loans are done by regional banks. And so the bank failures have just made that even worse. And so what's happening is, the Fed is sucking money out of the system, interest rates are going up, so it's becoming more expensive, the cost of money, and interest rates are higher, so people are taking their money out of the banks. And so when money goes out of the banks can't make loans. So we look at this. One of the ways that this is measured is by the Senior Loan Officer Opinion Survey. And before the Silicon Valley Bank collapse in the first quarter of this year, 45% of banks had tightened their lending standards already. They're charging higher premiums on riskier loans. They're increasing their spreads over the cost of their funds, and they're tightening the covenants and collateralization requirements. And this is all before the bank collapses. And as these bank deposits shrink, it limits the amount of loans that the banks can make. So this is actually the tightest the lending has been since COVID. So this was the chart that I saw that shows that the banks are really tightening their lending practices, and it's just a combination of things: the commercial lending, the commercial real estate, inflation, the regional banks getting in trouble. But look at that. I mean, during the COVID crisis, we're almost back up to the point, the same kind of tight lending standards that happened during 2020. So one last thing, I just again kind of related. All this is interrelated. Inflation. The CPI numbers came out, and everybody's saying, "Oh, yay! The inflation is going down," and it is going down. I acknowledge that, but I saw this picture on Bitcoin magazine. So CPI inflation is 4.9, but food inflation is 7.7. Electricity inflation. Now remember, electricity inflation 8.4%. So let's give up our gas-powered cars and pay more for electricity, right? But I'm paying a lot more for my gas car too. So transportation inflation. So what's happening is the real inflation, the inflation that impacts 90% of everybody, maybe not the super rich, uber wealthy people, but everyday people like you and me. Every time I go to the grocery store, every time I go to gas up my car to go to work, every time I want to go on vacation, every time I want to go out to dinner. I mean, isn't that crazy? I don't think you can get a meal at a fast food place, even McDonald's or whatever, for less than $10 or $11 per person. It's just crazy. So what I'm saying is basically this: you have real inflation, as Shaquille O'Neal and his buddy CPI inflation. I think this is the way the Fed's looking at things, and it's real inflation that is really painful. So for the average person, this is really hurting the average Joe. So I think inflation is going to be around longer than even the government is saying. It seems to be really sticky, and it's coming down, but it's not coming down very fast, and there are still a lot of pricing pressures. And it will continue to make everyday people and everyday things, more expensive and more painful. And interest rates, because inflation is going to stay higher longer, interest rates are going to stay higher longer. And that again goes back to the lending and the credit crunch. It'll be interesting to see whether these zombie companies, companies are going to, I saw a number somewhere, especially the commercial real estate, that over the next 1 to 2 years, a very high percentage of loans have to be refinanced. Companies have to refinance their debt and their bonds, and they're refinancing bonds and stuff that are paying they're paying 2 or 3%, and right now if they have to go out and get it, they might have to pay 8. And for a company that's not making enough money to pay the interest payment, then they won't be able to get funding. And you see this with the regional banks, where several of those regional banks tried to go out and get some funding, tried to find somebody to buy them or whatever, but their assets are so soured, so underwater, because interest rates have gone down. Have gone up, and the price of their assets have gone down. Then they basically were not able to refinance them in a favorable way, and their losses. So anyway, thanks for joining. I hope you found that a little bit insightful. I am invested in the market, but I'm also hedging a little bit. I'm also I'm close to retirement, so I have some of my funds are in investments that can't lose money, right? Even in a down market, the downside protection means that I make 0%, but at least I don't lose money. So if you want to talk about different strategies and diversification and asset allocation and different things like that, then please contact me. So the video's for educational purposes only, and we'll see you later. Thanks. Bye.